There are 152,000 gas stations operating in the United States today. By volume, they are one of the most common physical businesses in the country, occupying a corner of nearly every major commercial intersection in America. From a distance, the business model appears airtight. They are open around the clock, selling a highly predictable commodity that every single driver needs to purchase on a recurring basis for as long as they own a car. But getting into the market requires massive capital. Site preparation, the canopy, the convenience store, and the underground infrastructure typically demand between $1 and $3 million in construction costs alone. Factoring in high-traffic commercial land and equipment, the total price tag to open a new station routinely stretches from $1.5 million to well over $4 million. Despite that enormous barrier to entry, the math at the pump is shockingly weak. The average gas station in the United States earns a net profit of between 3 and 7 cents per gallon of fuel sold. The ubiquity of the gas station hides a structural trap. It is a high overhead operation where the primary product is incapable of sustaining the investment required to sell it. This diagram breaks down the revenue of a single gallon of gasoline. If the average pump price is $3.50, the station owner keeps a tiny fraction of a percent of the transaction. The remaining 98 cents of every dollar immediately leaves the property. It goes to the wholesale oil supplier, state and federal taxes, and the credit card processing fees and equipment costs required to dispense the liquid. A typical station pushes around 4,000 gallons of fuel a day. At an average net margin of 7 cents, that amounts to just $280 in daily profit. Over an entire year, a multi-million-dollar facility generates roughly $100,000 from its primary product, before standard business expenses. Operators have almost no ability to improve this margin. Independent stations buy unbranded fuel on the open market, where crude oil prices can fluctuate violently from month to month. The retail operator is merely a pass-through entity, absorbing the anger of drivers while capturing the exact same few pennies whether gas is $2 or $4 a gallon. Franchise owners operating under major brands like Shell or Chevron face a different constraint. They trade pricing control and supplier choice for brand recognition, but they remain locked into that exact same sub 2% margin. The millions invested in this real estate, the underground storage, and the massive canopy above the pumps do not exist to generate money from gasoline. The fuel is merely an acquisition cost for a completely different operation. The true financial engine of the property is located entirely inside the building. In 2024, convenience store sales accounted for 37.1% of total gas station revenue, effectively keeping the entire industry solvent. The economics change the moment a customer walks through the glass doors. Instead of a 2% margin on fuel, the gross margin on bottled water, chips, and coffee runs between 30 and 50%. If a driver buys $50 worth of fuel at the pump and a $4 cup of coffee inside, that single cup of coffee hands the owner more actual net profit than the entire tank of gas. Texas-based chains like Buc-ee's execute this math at scale. Their largest locations run 120 fuel pumps outside, acting as magnets to pull thousands of drivers into 80,000 square feet of retail space and full-service kitchens. The fuel is almost incidental to their bottom line. The modern gas station functions as a retail store that uses low-margin fuel as its primary customer acquisition tool. But supporting that retail operation requires burying heavy infrastructure deep into the earth, and what sits beneath the concrete carries an existential risk. Every station requires massive underground storage tanks, usually 10,000-gallon double-walled fiberglass units. These tanks endure intense structural pressure, and the EPA sets their maximum useful lifespan at 25 to 30 years. Approximately half of all existing gas stations in the United States currently rely on storage tanks that are approaching or have already exceeded that age threshold. As they age, they corrode and develop hairline fractures. When a tank fails, fuel does not stay contained. It migrates through the soil until it reaches the water table, irreversibly contaminating the groundwater that roughly half the U.S. population depends on for drinking water. Under federal law, liability follows the deed. If you buy a property with a leaking tank, you are fully responsible for the cleanup, which averages $154,000 and routinely exceeds $1 million when groundwater is involved. The previous owner, the tank manufacturer, and the oil company hold zero legal responsibility. Acquiring an existing station involves taking on a dormant financial liability, a potential 7-figure remediation project hidden just below the surface that can destroy an owner's entire net worth. Back above ground, the primary customer acquisition tool is losing its leverage. In 2024, electric vehicles accounted for 10% of new car sales in the US and over 20% globally, pointing the long-term demand curve for gasoline firmly downward. This chart illustrates projections by the Boston Consulting Group. As overall fuel demand declines over the next decade, up to 25% of all retail stations in the United States are expected to cross that unprofitability threshold by 2035. As the fuel volumes dry up, the math breaks. Small independent owners who lack the financial scale to subsidize their operations with massive commercial kitchens and loyalty programs will be the first to lose their foot traffic. The industry is already shrinking. Consolidation and tightening margins have erased tens of thousands of locations over the past 3 decades. In 1984, the U.S. supported over 200,000 gas stations. Today, nearly a quarter of them are gone. Relying on the internal combustion engine to guarantee a steady stream of foot traffic is a structurally flawed strategy for long-term retail survival. However, the transition to electric vehicles offers a massive opportunity for the convenience store model by maximizing the specific metric the business depends on. Filling a gas tank takes 3 minutes. Charging an EV battery takes between 20 and 30 minutes. That creates a massive increase in dwell time, keeping the driver stranded on the property. Industry research shows that EV drivers enter the attached convenience store 45% more often than traditional gasoline customers, and they spend significantly more money on high-margin items while waiting for their vehicles to charge. Capturing this new demographic requires yet another round of massive capital expenditure. Owners have to retrofit aging real estate and install expensive high-voltage charging infrastructure, on top of the millions they already spent burying tanks. From the canopy to the underground tanks, the gas station remains an architectural mechanism designed to monetize a captive audience's time.